Hey everyone, it's Mike, and welcome back to the Orderflows Absorption course. This is Module 4, where I'll be discussing accumulation and distribution. Now, before I begin, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right, so a major difference between accumulation and absorption is how the trading takes place. Now, absorption is noted when there's lots of passive activity occurring in the market. Accumulation occurs when there's more aggressive trading taking place at the beginning. Okay, and what is aggressive accumulation? Well, as prices start to increase, so does volume and delta, right? When the trading herd begin to sense that the trend is underway, they start coming to the market. At the same time, the passive accumulators start lifting the offers. The slope of price starts to steepen. The trend is underway. Next stop is euphoria, which I talk about in Module 6 in the trading setups. So let's take a look at the charts, see how it looks. So aggressive accumulation, buying imbalances, that's aggressive accumulation. That's the sure sign of aggressive accumulation. Obviously, the positive deltas, also another sign of aggressive accumulation. Now, where's aggressive accumulation I think more important? Well, I think it's more important near the lows, right? Now, people are going to say, well, that's not really accumulation, at your highs. Well, think of it in this, people are accumulating a position, right? When you think about accumulation, you really want to be accumulating stuff when it's, at the lows. But just because, you're at highs, don't think that we're not going to go higher, because we very easily go higher. People sort of fall into this trap where it's a two-way thing, okay, with retail traders. Either retail traders love buying breakouts and because they think the market's going to keep going up infinity, right? And there's the other sense they're always looking to short it. But if you're a long-term trader, you're not necessarily looking at, oh, we're trading at today's highs, I don't want to be buying it because I'm going to wait for it to come off. No, they're going to be buying it. They're going to accumulate the position thinking the market's going to go higher and higher. But again, aggressive accumulation, for me personally, I'd like to see aggressive accumulation near lows, just as I'd like to see aggressive distribution, which is the opposite of accumulation, at the highs, right? I want to see the selling imbalances come in at the highs. Just I want to see the buying imbalances at the lows, selling imbalances at the highs. And again, you're going to see it. If you don't see the selling imbalances, look at the deltas. What's the delta doing? What's the delta telling you? You're at the low here. Positive deltas. Okay. I know that people are lifting the offers more than hitting the bids. That's what I like to see. How's the volume? Is it light or is it average or is it heavy? If it's average or heavy, that's a good sign. How's the volume? Well, other than the big bar here up at 16,000, these are very decent chunky volumes here. You got 7,000, 7,000, 6,000, whereas earlier you're trading 4,000, 5,000, 3,000, 3,000. All of a sudden you're trading almost double that in here, 7,000, 7,000, 6,000, and it's strong negative deltas. Now, passive accumulation, trends begin when they're slow and steady buying. Slow and steady wins the race, right? Traders are careful not to show their hand by buying too much at once. There's no volume bursts, okay, with passive accumulation. And what I mean by volume bursts, right, when I'm talking about passive accumulation, it's absorption, basically, right? This is where institutional trader has its advantages. I guess I could change that from passive accumulation to absorption, but I look at it the same way. They can layer in their buying and even do opposite trades to give the market the impression there's supply at low levels, right? Now, I don't subscribe to this theory of, you gotta sell 100 to buy 1,000 like that. I've never, other than about one or two traders in my life, never really met anybody that did that in the markets. It's one of those gray areas. Is it illegal? I don't know what the actual ruling is on it, but if I want to buy, I'm going to buy. I'm not going to be playing games with them to try to jimmy the market. I'm not going to try to sell down a sell 100 contracts to just push it lower a couple ticks, attract some sellers in, and come in and buy some more. But there's people that talk about it, but honestly, it's one of those things that it just doesn't make sense. As for me and most other traders, when we're working, all our trades that we do, we got to explain, right? And it's a lot of the people I work with, the integrity is, well, why would you manipulate the market like that? So I don't fall into that market, but into that way of thinking. But there's some people do. They say, well, I'm trying to disguise what I'm doing. There's other ways you can disguise than try to be disingenuous to the market. So what does passive accumulation start to look like? Well, you're down here at your lows. You got the positive deltas. But look at this big bar down here, the big red candle. Down here at the bottom, 1100, 1200, 1000, 1000. You come down in here, it hits this pocket, right? You got the big strong negative delta. Why is the market going any lower? Well, you got some buying starting to appear here. Some more buying in here, more buying. Then it turns aggressive with the positive deltas as the market starts going back up. You went from your passive accumulation to your aggressive accumulation. You take a look at it here, right? You can see how it just comes down in here, this big buying area here. You can see it a little bit in here as well before you hit that low. But really what I'm looking for is when it comes down into this low here. But again, like I said earlier, right, you're going to have, as you're coming down into new lows or testing the lows, look for the supportive buying in here. Just as if you're going into highs, look for resistance selling. It comes in here. And then as you get down in here, look how it changes. Mostly aggressive buying. All this bar is almost all aggressive buying. This bar is mostly aggressive buying. Now, if you're looking at a volume chart, now I didn't really talk about this one very much, but this is a volume footprint chart. So it just gives you the total volume. It puts it on one side, so don't think it's all negative or all positive. It's just the total volume at each price level in a bar. And notice as you get down here into this low, look at that. 2000, 2000, 1600, 1500. Right, even here 79. People say, well, you got price exhaustion. You got 79, 1502, 1600, 2100. You can argue that, but really what you're looking at is this pocket in here where the market just sort of came in. That's what I'm saying, is like the sleeper cell. So it gets activated and then people start buying. Look at this bar here. This is an interesting bar, right? Thin volume, it's a big green candle, but you got this big pocket of volume up in here, right? Value area is higher up in here. Obviously, this is where the majority is starting to go higher. It's migrating higher. So passive support. Why do I have accumulation there? That should be okay, so passive accumulation is a form of absorption and occurs when aggressive big selling volume appears, but price doesn't move lower. Prices don't move lower. As the market is selling off, passive buyers absorb all the selling by the aggressive sellers. Now for a passive buyer, it's tricky because you don't want to absorb too much, because then you give the market the impression of support in the market, right? And the reversal is going to occur as sellers back off knowing they have reached an area of buying. So you can see it down in here. Depending on which sort of chart you like to look at. There's your passive accumulation. Passive accumulation. Passive accumulation. Passive resistance is the opposite, right? It occurs when big aggressive buying volume appears, but price doesn't move up, right? This passive distribution, which is the same as passive resistance, is a form of absorption as well, right? When you think of resistance, think of distribution, right? You're running into an area where you have supply, right? That's what causes resistance, is supply. And it's when people are distributing it out, what they're doing is they're working offers, right? That's your resistance. It's a form of absorption. What's happening? Price should move higher, but because it should move higher because of the aggressive buying lifting all the offers. But traders with supply offered out to those buyers, right? Everyone's willing to buy, but you have willing sellers, right? That's what everyone overlooks oftentimes, is the opposite side of the trade. They all think, well, I got aggressive buyers. That's very bullish. Well, yeah, it is, but take a look for a second at the selling that's going on. If the passive sellers are able to distribute their supply without much effort, if there's a pool of aggressive buyers, right? That's what I was talking about earlier, how the long-term traders, they will distribute on moves up, right? They don't wait till the market starts turning to start to distribute. I don't really like that term, distribute. Let me just say, use a term. Let me rephrase that as, that's where they start selling their excess supply, is on the move up, right? So if you're wondering why the market can move lower on positive delta, that's why. It's because you have people offering it out, right? Big offers. People are lifting it. The aggressive buyers are buying it. You got +1 every time they trades on the offer in the delta. So then what happens? The buyers finish. You got the positive delta. Market starts ticking lower. Bar closes. The red candle, positive delta. That's how markets move lower on positive delta. The positive delta occurs early, and then it just drops down. And here's positive delta. Look at this. Kind of move lower. Positive delta, positive delta, positive delta, positive delta, positive delta, as we're moving lower. Why? Look at these buying imbalances in here. Buying imbalances. What you have is people offering it out, offering it out, offering it out, offering it out, offering it out on the move lower. They're offering the supply. People are coming in buying it, thinking, hey, this is great. Oh, wow. We were just trading, they think the market's going up to 08, and, they bought at 04. I'll say, hey, it's offered at 03. Again, I buy another one. Offered at 01, buy another one. That's what's happening. But the seller's probably got a lot of supply in his back pocket. He's not showing it all, but he's putting, distributing it out there on the move down. That's how trends happen, right? You got your resistance selling. Yeah, you've got your passive distribution, so to speak, occurring there on a trend down, just as you'd want to see passive accumulation on a trend up. Now, when long-term sellers start offering a healthy supply, the selling will shut off the buying activity, which causes the market to reverse. And what that means is, the aggressive buyers are buying, but what you have is you got the big guys, the really big guys sitting behind them. All of a sudden they come up. This is like in those old movies when they, from the trading floor where the guy's just sitting there reading the newspaper, and he just comes, all of a sudden he looks up, sees oil prices trading high. He comes in to the market, starts selling corn, at these high levels. Market starts going down, then he sits back down. That's what's happening. When the sellers believe the market has reached an extreme high in the trading session or even the trading range, sellers recognize the market's overbought, and they start supplying at the bid. The move up will end, and a move down will come in, and the move will reverse. Here, crude oil, market's rallying. Okay, now they're starting to distribute. Boom, market's going down. The big up bar, people are starting to distribute in here, imbalances. They're holding it down. This is a chart I showed you earlier, actually. It looks, these charts, honestly, a lot of the charts look alike. Because you see the same thing all the time in the markets. It's not like, how to say, it's not like a aberration where it happens once in a while. I mean, you could look at these charts day in, day out, and you see the same things happening day in and day out. So when long-term traders distribute to short-term traders at highs, there's a very high probability the high will hold. Okay, again, anytime you're at a high or low, you should be asking yourself, are we going higher or are we going to reverse? If we're at the low, are we going lower or are we going to reverse? What's the chances of that happening? Now, accumulation does not always result in a move up. Okay, that's where people that live and die by Wyckoff methodology, they swear by it. No, it's accumulation, got to go up. Well, if accumulation is underway and prices moving down or sideways, You don't know yet if the accumulation is going to be enough to move the market higher. Yeah, it should be, but what's the difference between accumulation and distribution? Then you need a sign, right? If you're at a high, now the basic thing is, right, if you're at a low, everyone's going to say, well, it's accumulation, or if you're rallying and you pause, they'll say that's accumulation. But say you're in the middle, right? If you're at a high, you're going to say you look for distribution. You're at a low, you're going to say look for accumulation. But what if the market's trending up, okay, going sideways? Do you got accumulation or you got distribution? Market can easily sell off, and people say, well, you got distribution there, or market or rally, and say, well, you got accumulation there. You need a sign. You can't trade after the fact. A lot of people look to the chart and say, there's accumulation here, or you can see how the market was in distribution mode. It's always easy to Monday morning quarterback the market, right? So what's the sign the market can move up? Going sideways here, what's the sign? Look at the imbalances, look at the deltas, right? That's the clues. Where's the big volume? You look for the areas of big volume here, 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 here. Obviously here is a big one, but that's the 3 o'clock close. I'll talk about the closes later. But what you're looking for is what's happening in the market. My gosh, you're looking at this fish, man. Is this market going up or down? I can't make heads or tails. Look for the signs in the deltas. You got your big volume bar here. Granted, this is a doji, big volume, 17,000. Doji candlestick, guys, you know what that means. Market indecision. Market could go up and market could go down. Okay, well, let's take a look at what's happening in the delta. In the next bar, positive delta. Next bar, positive delta. So you got a couple bars with positive delta. That's more bullish than bearish. Point of controls. Okay. You have any imbalances? No. So, put a gun to your head. What are you going to say? Accumulation, distribution? Honestly, I wouldn't say either. I would probably be looking to stay out of this because it's too choppy, right? Don't be trying to see things in the market that aren't clear. Stick to the ones that are clear, right? That's the problem with, everyone talks about over trading. You're trying to read too much into what's happening in the market sometimes that, yeah, I can make the argument that it's bullish, but then if it goes down and fails, I wouldn't be surprised. Just because I got an argument that is bullish, it's not a strong enough argument as it is here. This one is much stronger. Stringing together all the positive deltas, even the one negative delta is quite small. You got the buying imbalances in there. It's happy days. Here, this one is like, oh gosh, man, I don't want to be trading. And there's no reason to. It's not clear. If you're looking at the big volume, okay, so this is the volume chart. The volume the volume at price footprint. This is the same chart here that it is here. But again, this is where some of the stuff is going to come in handy for you. Look at that. You're probably not noticing it in here. Look at this, 4,000. Where else do you see 4,000 in any of these bars? You don't see it at all. 2,800, 3,600, 2,9, 2,6, 2,4, 2, 2,1, 4,000. Right below a 2,7. And you got a couple 1,200, 1,600. So in here, there's heavy volume at this low. That's really the only clue. But again, you have to train yourself or look at a different chart to see things. You look at a chart like this. Honestly, I probably wouldn't have been able to pick it out until I look at a chart like that to see it more clearer. Over here, again, you got that big bar. Now, this is 3 p.m. 3 p.m. is when the cash closes, and that's generally when you're going to have your most volume in a bar at the 3 p.m. cash close. So whether you look at a 1-minute chart, a 5-minute chart, it's 70,000. Gosh, it's 70,000. That's because it's the cash close. Everyone likes to try and peg the cash close in the futures, the big traders. People that are working cash against futures. But really, the only sign in here, again, it's hard to see, but you know what? If it's important enough, spend the $100 on an extra monitor for goodness sakes, and throw up a volume footprint, a volume chart, this chart, in addition to your footprint chart. So you can see the stuff like this. Or maybe you want a delta chart, a linear delta chart. You know, it's the price of computer monitors is ridiculously low, but if it's going to give you a trade like this, it pays for itself in a short time. Again, this is stick out volume right here, 4,000. The 2,779 is already on the big side, but then it's massive right in here, 4,000 on a doji bar, on a bar of indecision, and the market goes up. So if short-term traders sell to long-term traders at a high, chances are the market will keep going higher. But honestly, this is very tricky to see in the order flow. And basically what you have is you got weak traders selling to weak hand traders selling to strong hand traders is what that is. That's what that translates into. What do you think is going to win, the weak hand or the strong hand? Well, the strong hand is going to win 9 times out of 10. But again, it's kind of tricky. See in the order flow, it's probably not something that you're going to want to try to see, because you know it's like you'll probably see it when it's not happening. You gotta get used to seeing it, right? So trending market's going higher, failed divergence, failed divergence, failed divergence, failed divergence. And again, I had talked about this earlier in one of my videos. When you start seeing groups of divergences that failed, that's a sure sign of a trending market, especially if it happens early on. This is cash open here, 8:30, and you're seeing it already by 9 o'clock, 10 after 9. You already got 3 failed divergences. But let's try and see, you know, if you can see who's selling to who. Is it easy to see? No, of course not. But what you can do is you're looking at these imbalances, right? Buying imbalance, sorry, selling imbalance here, selling imbalance here, selling imbalance here, selling imbalance here. You're seeing supportive buying here. It's a selling imbalance. So you're making these highs. Someone's bidding it up, right? You know, you're not going to get big bids on the smaller trader side. You're going to get big bids from the longer term institutional traders. They're the ones that are going to be working big bids, not the retail traders. So when you start seeing at your highs, you're seeing these selling imbalances and the market's still going higher. I know that there's support in this market. And look at this. These 3 imbalances right around the same level. They're still going higher, selling imbalances, right? The sign of retail traders are the buying imbalances at the highs. But when you start seeing selling imbalances at the highs and the market's not selling off, it's telling you someone's supporting that market. So the retail traders are selling to the longer term traders there. Okay, again, you know, who's selling to who? New highs. You're going up there. Look at this. I could just, you know, to me it's a little bit easier because I'm so used to looking at footprint charts. But again, if you're looking at this and you're not used to it, you might want to, you know, switch to the delta chart. Okay, maybe not the delta chart or the pure volume chart. Look at this volume: 4,000, 3,000, 3,600, 4,600, 5,421, 4,441. Again, all that is just the linear volume. It's going to show up on the one side as opposed to in the middle. Can't, because that's where the price bar, that's where the candle is. If you're looking here, you can sort of see these pockets in here. Support, support, support. And look at these numbers. Minus 1396. These are delta numbers. Minus 1200. Minus 700. Normally, you're seeing volumes in the hundreds. Less than 1,000. But you're getting these big numbers here. 1300, 1200, 772, 646, 898. So you know there's supportive buying in this market. So who do you think is doing that supportive buying? That's the longer term traders. Shorter term traders are lifting the offers. Okay, but again, you got to understand what is average volume, whether you're looking at a delta, whether you're looking at a volume, or you're just looking at a normal footprint chart. If you're just looking at this, you can see these volumes stick out. Even here, 2,500, 2,500, 2,600. But then look at this, 2,000, 3,000, 2,000, 2,500. Some heavy volume being bid here. The retail traders, they just tend to lift the offer. It's not to say they can't work bids, but their collective size is much smaller than the bigger institutional traders. You know, I don't believe the fact that some traders like to say, well, retail traders only buy and sell at the market. No, you know, they work bids, they work offers just like everybody else. It's harder in these markets like the S&Ps that have such big size, because you throw in a bid, next thing you know, you got 500 in front of you. You might not get filled, and that's why people tend to lift the offers. But still, you know, people are patient sometimes, and they'll work bids. Now, when long-term traders take the offers from short-term traders, the market can keep going higher on less volume. Now remember, everyone says about volume, rising prices should be accompanied by rising volume, right? That's Dow theory, you know, states that, you know, a bullish sign of the market is higher prices with higher volume, but not always. All right, look at this volume going up here, this move right here. 1100, 1300, 1200, 3,500. This is a new high here, 1270. So on this move back up, it's got less volume. Earlier, you had some decent volume. 2,000, 4,000, 2,000, 2,000, 3,000. You know, you hit your high here at 2,400, 2,500. Comes off, starts going back up on lesser volume. What's price doing? You know, we're making these new highs. The volume's lighter here. You get up here to these highs, you know, 200, and here is 400, 300, 300, 400, 400, 669. You know, here you got heavy volume, 1,700, you know, 600. You know, back here you're trading 700, 600. Volume is much lighter here. Granted, it's just after the futures, once the futures close, it's a euro currency, right? And this is happening at 2 in the afternoon. Volume does dry up. You got to understand what's, you know, the times, right? Because people, they think, well, the market trades until this time, that trading volume should be consistent. Okay, here, this market, this is gold, right? This is at 10 in the morning, 10, you know, just before 11. We're making these, going up here on highs, move back up to the highs on smaller volume. That's going to be more important than here after the 2 o'clock close is here, right? That's why you got that big volume, 1791. That's when the floor used to close. Obviously, now with electronic trading, it's still open, but that's why you see big volume go through at 2 o'clock in the currency contracts, is because that's the old close. That's when people in New York tend to close their books, basically, at 2 p.m. Chicago time, which is 3 p.m. New York. But we're still going higher on you know, slightly lesser volume. It's partly due to the fact that, you know, traders are, you know, the big traders are sort of done for the day, but still, you know, keep an eye on it and watch it. But here we're going higher on less volume, right? Well, we're not supposed to do that. You know, Dow theory says we're not supposed to do that. Well, watch what happens when we get up to these highs. You know, pay attention. You know, look for the signs. We're going up there on lesser volume, but look at the deltas are getting stronger negative up here as you're getting up here. 400, 200, 200. You got a small delta of 20. I'd be looking, you know, potentially for that sell to come in. So accumulation patterns. Watch max delta over the last several bars. Distribution patterns. Watch min delta. Now, that's not something I really touched on earlier. If you have my delta course, you know, I got a whole section on max and min delta, I believe. It's important, right? Because is it in concert with the move, right? So you can see here what's happening. We got to look at these min deltas. Minus 160, minus 114, minus 246, minus 138. But we're going higher. What's that telling me? It's telling me you have supportive buying in this move up, right? Look at this volume down here. Where's the volume in these green bars? Towards the low. So every time you open up, trade higher, come down to the lows, you got a lot of activity. Market rallies up, market comes down, a lot of activity. Market goes up, market opens up, comes down to here, a lot of activity, a lot of activity, a lot of activity. So I know that there's supportive buying in here. Okay, so this is, you know, on move. I say, you know, keep it relative to what's happening in the market. So once you understand accumulation distribution, you can start to form a trade setup. Accumulation and distribution by themselves is not a reason to get long or get short, I don't think. For me, it's more of a starting point. When traders are accumulation mode, are accumulating, what are they doing? They're working bids, right? Generally, they're willing to lower bids if they think aggressive sellers will go there. Passive buying, passive accumulation does not move prices higher. Passive accumulation is the bids, right? They're absorbing what's going on, the selling going into the market. So when accumulation mode moves from passive accumulation to aggressive accumulation, the prices start to rise as buyers think that the last seller has sold, and sellers become exhausted. And then the buyers start lifting the offers. Okay, so before I end this module, I just want to go back to this slide here. Accumulation patterns. Watch max delta over the last several bars. Distribution patterns. Watch min delta over the last several bars. I just want to explain this a little bit further. So distribution. Watch what's happening in the min delta. Do you have strong min deltas in here? Do I think the market's distributing in here? First of all, okay, what we'll be looking at is obviously the final deltas, but we're watching these min deltas. Here, look at this. Here it's 0, 0, small, 52, 2, 33, 45. But all of a sudden up in here, right off the high, minus 500, 153, 331, 240, 888. I know that there's selling pressure coming in here, even though the market's not going down yet. Right, that's important information. Now let's see here in the accumulation, right? What's going on here? Coming down into the low. Do I think there's accumulation? Well, here we've got 1500, 1987, 2600, 3000. Do you have anything else like that? Not really. Over here you got 3000. Here you got 4000. But everything else mostly is negative selling. These are min deltas: 2000, 700, 2000, 4000, 5000, 3000, 1500. Well, this is E-mini. This is 8. The first 15 minutes of trade, you tend to get heavy volume, but still, watch what's happening. It's closing this bar here. 26.28 is your max delta. Final delta was 25.77. That's a very bullish sign as well. So I hope that clears it up a little bit for you, so understanding, when I say look at them in relation to previous bars, are they high? Even though it may settle here, like here at 1500, it only settles at plus 800. I know that early on in that bar, there was some signs of life, the aggressive buying coming in there early on in that bar. But then, it was met with, obviously, some more aggressive selling. The selling wasn't quite done yet. That you got the delta down to 802 from 1546. So this concludes Module 4. In Module 5, I'm going to discuss reversals and continuation. Now, not all absorption leads to a reversal. It can also lead to a continuation of the existing trend. In Module 5, you're going to learn the differences to look out for. So I'll see you on the next module. Bye-bye.